understand what's going on in the bigger economic, business, social picture. And you've been amazingly accurate and helping us to understand what was happening, what was likely to happen, and how best to respond in our businesses, in our lives, in our investment to deal with the economic world around us. Larry, you took a little sabbatical. Most people take a sabbatical from teaching. You took a sabbatical to go teach, which is what we'd expect from you to be the opposite of everybody else. And welcome back. And Bob, you've held the things up while Larry was sunning himself on a beach with all those little pineapple drinks in his hand, and helped steer us through some really interesting times. So, in a week or two now, where we have had a new, not so new president inaugurated, uh, we've had a flurry of executive orders come through, lots of changes. We've had a big jolt to our understanding of what's going on around us in the last several days, which is the introduction of a new LLM from a company, and they're calling this new LLM DeepSeek R1, and it's, as Mark Andreessen commented the other day, if what we hear is true about how much it costs them to build a model and what kind of chips they were able to do it on, Mark Andreessen, who's someone Bob Diamond and I have a lot of time for, called it a Sputnik moment for the AI community. And indeed, it's looking to be very much that. So you have a new situation in the Gulf of Americas. You have the America's Canal. You have the not so Greenland. Lots of plates spinning at one time. Bob, your theory that we talked about a lot during our last quarterly call was that it was never a better time to be an investor and a never more important time to be an investor in regional and community banks because they're so important to our economy, to our business communities. And now, with all these changes, what say you in terms of the impact on your thesis? Particularly the last time we chatted, you talked about the cost, why they needed to merge and get bigger to withstand the burden of the technology costs that they had to endure from a defense point of view, from an operations point of view. And now it looked like the cost of that technology might be coming down from where we thought it was a quarter ago. So, Bob, what impact do all of these changes have on your thesis about now's the time and now there's a real need to have a strong, vibrant regional and community banking community?
Thank you, Jim. And I think the thesis is fairly straightforward. These banks provide tremendous service to middle market companies, family offices, a service not provided by the big four banks. They're very necessary for our economy. 4,500 is probably too many. It's going to consolidate to closer to 1,000 to 1,500. Many of the smaller, very successful community banks, typically private, are too small to succeed. They can't manage the higher regulatory costs as a result of the SVB failure and the higher technology costs. So we're well down the path to implementing this, Jim. And then two things have happened in the last couple of months. One is with the new administration, it's business, business, business. Deregulation is okay. More regulation is not. We finally have Gary Gensler out of the SEC. Thank goodness he stopped progress in technology and very, very legitimate business combinations for 4 years. And his partnership with Elizabeth Warren has been very, very bad for business. So we have a let's do business, let's allow consolidation. It's good for customers and it's good for competition with the big four. And now, as you said, secondly, if what we read about DeepSeek is correct, it's more efficient, it's less cost, and as Larry and I have talked for a while, AI is a huge leveler. Um, Over the last 10 years, it's been the JP Morgans and B of A's that have been able to spend billions and billions on technology and AI. And if that is applicable to the smaller regional and community banks as they combine, wow, what a benefit to them. And I think we're seeing, um, um, you know, a lot of factors come into play here where this consolidation is going to accelerate. So thank you for the question. And I think everything we're hearing around AI and DeepSeek, I think is good for AI. It's good for business. It's bringing more efficient, less expensive technology.
Larry, should we stop working on that nuclear reactor in our backyard because there's an energy consequence here too, isn't there?
Uh, yeah. Well, I mean, it's interesting because the president has talked about an energy emergency. Bob and I had a long discussion about this the other day. Um, on the energy side, things already look great for the U.S. We are already energy independent. The U.S., thanks to the shale boom and developments in hydraulic fracking, we are the number one producer of oil and natural gas in the world. We became a net exporter of natural gas in 2017, a net exporter of oil and petroleum products in 2021. And to be honest, drill baby drill has, well, not drill baby drill, but produce has been the word for the US. In fact, at this point, we've got some natural gas producers in Texas that are producing so much they're producing, they're losing money. And to get more production at this point, we would need actually higher prices, which I don't think anybody wants, but we're already drilling. So the energy sector in the US has been doing great. And anyway, so no need for an emergency on that area.
What about the overall outlook? When I chatted with you last, Larry, you had recited a whole bunch of statistics that said, I think the last time you were with us in person,
Yeah.
you called it the Larry David economy. Everything was pretty good. Still pretty good.
Yeah, it is actually. The last 5 years, we've been doing these things, and we've pretty much always been uh, at a consensus. In other words, markets either on the economy or inflation or what the Fed's going to do. And at this point, markets have mostly adjusted to the notion that this economy can handle higher rates, and and that the inflation's unlikely to get down to the 2% target for the Fed anytime soon, even though it's not far off. It's about 3%.
Yeah, but that's
There's an
50%.
FOMC. Yeah, so we, right now the market's pricing in another quarter point or two, really 50 basis points this year. That doesn't seem so far off, although I think the risk is probably they do even less than that.
Nothing at
And
this meeting.
there's a Fed meeting today, as you know, going on, and there'll be an announcement this afternoon, and it's almost a sure thing. They're just going to leave rates where they are. They've already cut 100 basis points. We're down to a target range of 4.25 to 4.5 on the funds rate, and they'll leave it where it is. And
And
you
Bob
know,
pointed out to us the last time in your absence, Larry, that 4.25, 4.5 range is the traditional range pre-recession of 2008-9. You had 20 plus years of 4.25, 4.5, right?
that's right. It's interesting. Again, Bob and I have talked about this a lot. In the decade
You guys
before
talk a lot.
COVID, yeah, we do. The decade before
We always
COVID,
agree.
10-year treasuries were trading in a range of 1.5 to 3%. If you look historically, that's just incredibly low. And I think we're back to a more normal environment where you're going to see 10-year treasuries in sort of a 4 to 5% range, which is where they are now, at least. We've got bigger budget deficits. We had trouble getting inflation to 2%. Things have changed since COVID. Firms have diversified their supply chains. There's a lot more emphasis on producing at home. Um, and there's, just-in-time inventories. Firms now keep higher inventories in case of the risk, which is what we saw during COVID. So we're no longer, and trade, this is a big thing. It gets to tariffs. The free trade train, which helped bring us lower inflation, is going in the opposite direction with more tariffs and restrictions and so forth. So we're not going back to 70s or 80s inflation, no way. But I think instead of 2%, you're talking more like 3%. So the economy, real GDP is running close to 3%. That's inflation adjusted. That's good. The unemployment rate's 4.1%. That's full employment. And you know, inflation was running 9% at its worst. It's now running 3%, which is good. Now, I know most people, that's their big issue. And that's because people care about price levels rather than how fast they're going up. And price levels are a lot higher than they were uh, a few years ago. So,
What's
and
the
you look at
cumulative
financial
impact of
markets.
inflation over the last 4 years? You had a 9% year, we're back down in a 3% range. You had five
Right,
there, 7%. Cumulatively,
right.
what the cost of eggs 4 years ago versus today, except
Yeah,
for this bird flu situation?
yeah,
Is it a 40%, 30%? What has been the cumulative inflation
yeah. I
impact?
mean, it's a good question, Jim, and it obviously varies over different things, but most of the action has been in goods.
Not in the
And
cost of gasoline. That's about where it was, isn't it?
the gasoline, yes, but all kinds of other things. And now, actually, lately, the big up and down was goods, right? Why did that happen? Because during the pandemic, nobody was traveling, nobody was going out to restaurants, they were staying at home. So they had more money to spend on that stuff. We had huge fiscal stimulus, and they bought tons of goods to make home life more comfortable, right?
Yeah, they
And
bought a
it
lot more
happened
flowers.
at a time when there was a massive shortage of goods because there was a shortage of workers. So you had this, and then everything went down. Used car prices, new car price, all this stuff went back down. Now, as people started going out and about again, services prices went up
Yep.
and started going up again. The big decline in goods prices is over. So we had this big drop in inflation from 9 to 3%. They're not going up a lot, but they're creeping up again. And services, people still making up for lost time by traveling and go to a restaurant or a bar in New York or a gym or salons. They're back full boat, air travel and so forth. So, we're sitting here with somewhat higher inflation. It's not terrible. By the way, financial markets reflect this. It's interesting, Jim. We have a new administration. Everybody's watching it. There's a lot of changes, but the S&P went up 25% in 2023, 25% in 2024. Since the election, what is it up? It's up at a rate that if you annualize it, it's about 25%. And that even includes the big drop on Monday. Of course, a lot of it came back yesterday caused by, this information you talked about, Jim, that, maybe AI doesn't require the kind of expensive chips that NVIDIA
A couple of
is
weeks after
producing.
a
But
$500 billion expenditure was announced.
right. But that's more about which stocks are going to do well, not
Hmm.
if AI is going to do. As you said, it's in a way it's a net positive because it sounds like it's going to be a lot cheaper than we thought to do this. But implementation is the key thing, and that's going to affect a lot of industries, whether it's commercial real estate, financials, stock picking, all kinds of things. Jim, we were talking the other day about the consulting firms, and it's all going to be about implementation.
They're
How do we?
printing it right now.
Yeah. So anyway, so the
So the
market
economy is still
look
pretty
good.
good. 3% inflation would yield a
Right.
12.6% net increase in product cost at the end of 4 years.
Yeah.
But Bob,
Right.
Larry, my theme for the last four calls, probably 4 quarters, has been there's two Americas. And if you're an asset owner, if you have a 401k and you have 20, 30 years of savings in that, and you're looking at 25% returns that you just talked about in 23 in the market, and a 20 plus 22% return last year in the market, you're feeling pretty good. If you have a home and you have substantial equity value in it, uh, you've kept up with inflation or close to keeping up with inflation in terms of your real estate cost. But if you don't have investments, if you don't have assets, if you don't have real estate as one of those assets, the gap, our kids or the next generation coming through, that big first step to get onto the asset train is getting bigger. I think there's half of this country, the half of the country that's paycheck to paycheck, which may be more than half, they're struggling with that compound 25% inflation in goods over the last several years. Is that gap getting wider? Am I just hung up on that?
Oh, it is. There's no, well, what happened is income inequality was going up for a long time, actually. Um, During COVID, actually, it shrunk somewhat. A lot of it was due to the financial stimulus, extra childcare, tax credits, and things like that, and stimulus checks, which, as you know, it went to low income people. But it started to widen again. You're absolutely right, Jim, and it's a huge social issue. I think, when you sit here now, yeah, you're right. I mean, the Larry David thing, it's pretty good, whether it's financial markets, whether it's the U.S. economy. But I think the thing now is everybody's watching what's Trump going to do. Um, and, you know, I'm an economist. There's a reason they call it the dismal science. I mean, Bob's right. The regulatory thing is probably the most positive thing that is probably coming up. Although now DOGE, the Department of Government Efficiency, Ramaswamy was the one focused on less regulations. Musk, who's running it now, is more focused on things like technological innovation in government and automation that'll make the government more efficient and require less people actually. Bob's right, definitely. I think banks are going to be deregulated. We definitely need more consolidation in the banking system. It's been going on for a while, but and it's for the better to serve local communities. I think that's all good. And look, you don't want to discount Musk. I don't care what you think about him, but you look at Tesla, you look at Starlink, you look at SpaceX, and when it comes to technological innovation, he certainly knows what he's doing. How much he can get done is another question.
Well, I saw Bob
but
was
my
on.
worries are tariffs. My worries are tariffs and immigration. I don't think there's going to be much change on the fiscal side. I think the Trump tax cuts will be extended. I doubt you're going to get a lot of new tax cuts given how big our federal debt and budget deficits are.
Well,
but I think
let's
we'll
come
get
back
the
to that federal debt,
which is no change.
Right. Bob, let me ask you before we ask Larry to tell us the impact of this, of the federal spending, the deficits we're running, and the accumulated debt. I know we have more than $1 trillion now of our budget. We have $5.3 trillion in income at the federal level, and more than $1 trillion is spent on debt service. But you're an expert on the global economy, Bob, having run one of the large money center banks of the world. And Europe in particular, what I was struck by, and this is all about Larry's point about regulation, Europe is even more regulated than the US. And since COVID, Europe, which has probably 50 to 80 million more people than the US, had a larger economy than the US, larger GDP than the US did pre-COVID. And now the US has a larger economy than Europe with less people. What's the impact of that? And you know Europe better than anybody I know. What does that portend for Europe in the coming years?
Listen, I think the burden is on Europe. I think the work done by Mario Draghi recently on the competitiveness of Europe as an economy was stark and telling, and they have a very, very strong agenda. But if there's a page out of the 2 pages out of the US success book that we can see implemented across Europe, it's to get the regulation out of the way of business. And two, it's to allow a banking union and banking integration and recognize that in the US, the deep, very diverse financial services industry with everything from private credit to hedge funds to venture capital to 4,500 small banks serving small businesses has been a huge part of the success of our economy. We're very, very resilient because of that. They need to celebrate the financial services industry across Europe and allow consolidation and success. and they need to get regulators out of the way of business.
That sounds
I think
cultural.
I don't think it's that difficult, to be perfectly frank. I hate to say it, it's that simple. Europe is becoming irrelevant as a economic competitor to the U.S.
Wow.
So could I just add a few things on the
Sure.
regulatory side? Because, look, deregulation, no doubt, as Bob said, can boost growth, lower inflation by increasing the efficiency of the private sector. Now, first, we need government regulations. I mean, it makes, keep our food, our cars, our planes, our workplaces safe and so forth. But it's understandable, the frustration with the sheer volume, even in this country, it's worse in Europe, as Bob says, is understandable. So the Code of Federal Regulations, believe it or not, is a balloon to 180,000 pages. And
Think
this
about that,
affects
everyone. Think about that.
everything,
180,000 pages.
1,000 pages. And it affects almost everything we produce in the economy. And when you layer that on top of state and local rules, it can make it really difficult for many businesses to operate efficiently. And even things like new and needed infrastructure to be built, there's just too much. So again, there's a lot of scope for whatever side of the political aisle you're on is for to streamline these things. And there's no doubt that the financial sector is one area that the Trump administration's focused on.
Bob, when you left Barclays, you said that there were cultural issues that would keep it from being good. And then in your comments about Europe, you said they need they need to celebrate success. The pensioners of the UK are dependent on Barclays for dividend income. There's maybe 3 or 4 UK stocks that drive 50+% of all the income that funds all those pensions in the UK, and Barclays is one of them. But their stock is 13 and change today, and when it came out of the recession, it was 7 and change. I dare say that every U.S. money center bank is a multiple higher than they were in 2011, and Barclays is $13 versus $7.
Yeah, the equity value of the UK banks have lagged because they've become utilities, and the regulators are worried about you know, principal protection on insurance, and now it's car loans, and what have they done wrong, and how can we tax them, as opposed to the US, which is let's put equity into these institutions, let's allow them to grow, let's allow them to consolidate, let's allow them to compete with private capital. Like, that competition has been good for banks. Compete with hedge funds, compete with private equity. It's been very, very positive. And in 2008, as we entered 2008, I think the European banks, Barclays is a good example, had a number in the top 5 in the world. Credit Suisse, UBS, BNP Paribas, Barclays, dynamite versus the US banks. Today, it's US banks, US banks, US banks, and the European banks, particularly the UK, have lost their sense of allowing businesses to succeed, celebrating success, allowing them to grow. And it's been a bit more like the Gary Gensler SEC of no, no, no.
Mm.
And so I had very high aspirations for the change in administration in the UK. They still have time, but I think the more this can be about the strength of the private sector. By the way, this is not just banks, but the private sector, getting regulation out of the way of real estate developments, building projects, developments in technology would be very positive, because we all know that London has been a great financial center, probably the #1 financial center in the world, and it's losing its competitiveness to New York, and it's losing its competitiveness, I dare say, to Dubai, Abu Dhabi, Doha, and Riyadh.
Boy, interesting. And I know you're close to and very fond of the leadership of Santander. Uh, is she doing things differently? Does the culture of Southern Europe, particularly in Spain, celebrate success as you talked about?
Man, that is a great question, Mr. McCann. And I should have had Santander on my list of European strengths. I think today they're probably the strongest bank in Europe alongside of UBS. And I do think, and I think Anna's leadership has been a part of it, but I do think that they have worked more hand in hand with the government in Spain to get them to understand that the success of the economy is somewhat dependent on the success of BBVA and Santander and the big banks. So it's been a much better environment for them to grow and expand.
So, Larry, you just blew our minds with that statistic about how many regulations we have here. Bob just painted the picture of Europe being even way more regulated than the U.S. is. And you said the biggest thing that you're anticipating that will influence the economy with the new Trump administration is the lightening of the regulatory burden. So let's put your prediction hat on here. What does this next year look like in terms of U.S. economy and growth?
Right. So just to clarify, what I said was among the sort of economic proposals, there's all sorts of things going on in the world, as we know, but that's the positive one. What I think, not just me, but almost any economist is worried about is two things. And it's not fiscal policy. As I said, I think mostly you're going to get extension of tax cuts, which is not a change to current law, maybe a little more, but I doubt there'll be a lot more tax cuts. The two possible negative factors here are a lot of tariffs, much higher than what we saw in the first Trump administration, and a huge reduction in immigration. So, and I'm not talking about the political side of this at all. So right now, Jim, it's hard to see a recession on the horizon. You're not seeing the excesses, except maybe in the public sector finances, they usually see before recessions hit. Both business and household balance sheets look healthy, and so you don't see that absent some big negative exogenous event. But I'll tell you this, tariffs are very simply a negative for the U.S. economy. They're like a negative supply shock. They increase prices, they reduce output. And the easiest explanation for why economists like free trade is nobody forces people or countries to trade. So it must be mutually beneficial. It's more complicated when you're talking about countries, and that's because certain sectors, there's social costs, and certain sectors of the economy get hurt, and certain sectors are benefited. The net effect is positive, but it doesn't feel that way all the time.
Yeah.
And what change have we been, we go back to the American Revolution, right? Over 90% of the population were farmers. If that were the case today, we'd be a poor country. And industrialization was a wrenching social change. When people moved to cities, they used to live on farms all their lives. One of the strengths of the U.S. is being able to absorb these changes and adjust to these changes. The big one that's happened is that the increase in free trade, the disappearance of the communist bloc, and China and other developing countries became huge manufacturers. In a sense, they did take our manufacturing jobs.
Sure.
But two things happened. One is by spending lots of less money on millions of goods, we spend more on other stuff, and that's increased business in other industries, whether it's cell phone or streaming services or traveling or whatever it is, and spending on technology. So what's happened is we've become, we were the kingpins of manufacturing. We aren't anymore. And we've lost manufacturing jobs. And
Did
a
the
lot
pendulum
of cities
swing
that
too far,
hosted,
Larry? Is that what Trump is trying to engineer here? Get the pendulum to swing back? We're not gonna become independent of our need for offshore manufactured items, but he's saying it's swung too far. We've
right,
hollowed out our middle
because,
class.
right, people think these countries, the foreigners are taking our jobs. In certain sectors, that's true, but it's not true net net. So, in other words, first thing is what I said, by buying goods so much cheaper, we can spend more on other stuff. And America's become the leader in technology, even with deep sea. Look at Google, Amazon, Facebook, you just Microsoft, the US is a leader in technology. The other thing that people don't think about, trade deficits have a bad connotation, right? What is it? It's not like a budget deficit. It just means we import more stuff than we export. Nobody seems to talk about the capital account. Foreigners buy a lot more of our financial assets than we buy of theirs. What does that mean? That increases we're a country that saves very little, but we still invest a lot. How's that possible? Right? Because savings goes into investment. It's possible because foreigners pour billions into our economy by buying our stocks, buying our bonds. And this increases the supply of loanable funds in the US, keeps downward pressure on interest rates, and creates the funds so that we can invest in all this technology. It's a good deal. Now, that's a lot less obvious than seeing towns hollowed out with loss of manufacturing jobs. But it's been a source of U.S. strength, and just about every study shows this. So if you're talking about 60% tariff, now I'm not saying this is going to happen. A lot of people think this is going to be used to extract concessions, and that may be true. Look what just happened in Colombia.
Oh, I was very aware of it.
And I hope it is true. But if you put 60% tariffs on Chinese goods, 25% on Mexico and Canada, those three countries account for well over half of all of our imports, by the way. It's like over 56%. You do that, it's going to increase inflation a lot. It's going to cause output to go down. It is not a good thing. Now, am I saying it's going to happen? I have no clue. And it could be just threats. That may be the case. By the way, just so you know, the current average tariff rate is 2.3%. Okay, you put that and then 10 to 20% on all other imported goods, that can give you a recession. It's the most infamous example is Smoot-Hawley in 1930. Which caused a global trade war. By the way, part of this equation is that when we do this, it always invites retaliatory measures.
Larry, 1930, you were just a young guy in the School of Economics.
Yeah. So, but it invites retaliatory. Even the narrow set of Trump tariffs in the first administration caused a manufacturing recession. We had a drop in 2019 of almost 50,000 manufacturing jobs. Why? China and the US and the EU imposed huge tariffs on all kinds of things. Agricultural products like soybeans and pork, blue jeans, motorcycles, a lot of stuff that the US for whiskey. I mean, there were all kinds of things, and it actually hurt. But that's nothing compared to these kind of tariffs that he's talking about. The other thing is immigration. And I'll stop with the negative stuff, but immigration is a huge source of strength in the U.S. If it wasn't, our biggest problem is weak population growth. It grew in the last year or so. It's now growing at a rate of less than 0.5% a year. And,
except in a diamond household, they're knocking out those grandbabies one after the other.
Well, we are.
So
we're doing our job.
All of that is immigration. So just to give you a quick stat, if it wasn't for immigration, we'd have had no growth at all in our prime working age population. None. Okay. Right now, immigrants account for almost a fifth of our workforce. All the studies show they actually add more to the economy than they take away from benefits.
All right. So before we come back to you for your hard predictions,
now, I don't. By the way, just to say, so far you're talking about thousands of people, whether it's deportation or whatever. That's not going to make a difference.
Sure it is. Sure it is, Larry, because the bad guys who are saying, hey, I can get back in any time, are saying, if I get thrown out now, I'm not going to get back in as easily. So it does have an impact.
Well, but
Fewer people are going
if
to
it's
come to the
hundreds of
border.
thousands or
No one's going to
millions,
argue that immigration is good for this country. It has been since our founding, but it's a
yeah,
form of immigration. Who comes? What skills? Do they come legally? Are they
right.
checked for
That's right.
affiliations with terrorist organizations? Are
Right.
they criminal? So we want legal controlled immigration. No one would argue. So
Right.
before I come back to
Okay.
you for your GDP pick for this year, your inflation count for this year, what happens in the next couple of quarters? You already talked about your prediction on the Fed. Let me ask Bob. I know it's like tossing a lob to Jimmy Connors at the net here,
Yeah.
but if the things Larry just talked about, the need for new infrastructure spending, the need for housing, which is becoming more critical every day, and the need for nearshoring, onshoring, reshoring of manufacturing, that seems to scream for your opening thesis about the importance and the dependence we have on community and regional banks, Bob.
Thank you. Thank you for that beautiful lob that you just gave me. Listen, one of the greatest attributes of our economy is the depth and breadth of our financial services industry. Everything bad ends up on the balance sheet of the banks overseas. In the U.S., there's a diversification. Um, our regional and community banks are a key part of that. They are not efficient today. 4,500 is the wrong number. And today, for the first time, we have a willingness to accept investment from people like Atlas Merchant Capital, new investors putting equity in and helping drive the acquisition of some of the smaller, too small to succeed institutions that are providing great services. I can remember, getting my first college loan in order to be able to go to Colby. You went down to the local bank in town, the community bank, but it was, guaranteed by the government. So it was a government program, but delivered that kind of service. I wouldn't have, taken a train from Concord, Massachusetts down to New York and gone to Bank of America. These banks are incredibly important for our economy, and consolidation will make them stronger, better competitors, and provide better service.
And better
We're
capitalized
here, ready to
because
serve.
you're prepared to deploy capital, which is a great thing to hear.
Right.
Okay, let's close, Larry. Give us your predictions. You already said the Fed no more than another half a point to a point this year, if at all. GDP, inflation, what happens?
I mean, I think the economy looks very good, and what you mentioned with DeepSeek is a net positive, as we said. It's not a
Except if
negative.
you're a
It's a
chip
positive.
manufacturer.
It's just a matter, right. It's just a matter of which you may shift your allocation among different
Yep.
companies for sure. But there's a lot, AI, just like the internet was the real thing, even though it got overdone and we had a bubble and it broke. That may happen with AI also, but it's the real thing. It's going to change things, and it's meaningful, and it's a plus. So I think things look very good. And to me, uh, what I'm worried, if you ask me the big risk, it's in policy. Is are tariffs going to go up meaningfully or not? This is a political question. I'm no political expert. Is immigration going to be reduced? And I'm like you, Jim. I'm talking about legal immigration. Is deportation of people who are here and working, that kind of thing. Is that going to happen big time, or isn't it? I mean, if it does, that is the major case for a recession if you get those things. Absent that, and the regulatory side's a big plus. I don't think there's going to be big changes in fiscal policy, as I said, other than continuation of what we already got in 2017. So I am cautiously optimistic, is what I'd say. I don't think the economy can
So
keep growing
here's the
3%.
headline.
But
Here's the headline, Larry. You've moved
yeah,
from pretty good
yeah,
to really good. And that's an amazing move for Larry Kantor, the guy who's had a crystal ball in his hand that's been as clear as can be for the last 2.5 years. So, Bob, good luck with financing all those regional banks to fund all the infrastructure growth we're going to need, to fund the housing that's desperately needed, and the manufacturing that's going to help to bring that pendulum back toward the middle. Lots of good things going on. And Larry thinks 50% higher than the 2% inflation rate's not so bad either. Man, I think I need to go out and invest.
Thank you, Jimmy.
Bob, how do I sign up for that regional and community bank fund? Thanks, guys. Thanks for another great quarters assessment of what's going on. There's so much to digest, and you guys are always on top of it. And today, no less so than in the 2.5 years before this. Thanks, guys. Thanks for your guidance here.
Thanks, Jimmy. You're the best.
Take care. Thanks.